Welcome to the John B. Levy & Company podcast. I'm your host, Rick Young. John, good to see you again.
Nice to be back.
Well, John, the Fed just announced its newest plan to help the economy along, try to revive the economy. How do you think the twist is going to affect commercial real estate?
Well, I don't think it's going to have any direct effect, and certainly not in the short run. I mean, borrowers certainly like the fact that rates are lower, but this is a two-headed snake. Lenders look at the lower rates and they say, gee, this is a reflection on the fact that we have a very weak economy, so therefore I'm going to become more conservative, make lower leverage loans. I don't expect any short-term impact on the commercial mortgage business. I'd love to say that it would increase things and make us more aggressive and more active, but I don't think so.
In an interview on the Fox Business Channel this spring, you said that financials were ahead of fundamentals. Do you still think that's the case?
Unfortunately, I was a little bit more prescient than I might have liked to have been, because in the spring, the financials looked very good. We were having lots and lots of success in both the CMBS and the institutional world, but it looked like the economy was weak. Unfortunately, what's happened is the economy has caught up, or either that or our financials have slowed down. So we're not doing nearly as well as we were doing in the spring. In fact, we're in a much more conservative phase than we were then.
When we talked in the spring, John, you said that CMBS looked like it was in recovery. Well, what is your outlook for the rest of the year?
Well, it was in recovery in the spring, and I think things looked like they were really on the roll. At the beginning of the year, we thought that CMBS volume was going to be probably 35, maybe 40 billion. We were on the conservative side of that, but there were people that thought 40 billion, 45 billion was the right number. Right now, it looks like to me that we'll be lucky to cross the $30 billion for U.S. originations. And in the spring, we might have said that things were doing so well that we could have gotten 50, maybe 55 billion. The 30 or the 32 billion for this year is certainly less than we saw in the spring, but keep in mind it's triple what we had in 2010, when we only had about 10 billion. So we're doing better, but we've certainly slowed down. In fact, most of the volume this year will be done in the first 7 months. So are we as optimistic as we were in April? Nowhere close.
If I want a CMBS loan or an insurance loan, what's the borrower going to find?
Well, you're going to find a bifurcated market, Rick, which is kind of interesting. We've never really seen that before. In the spring, we could go to the CMBS markets or to the insurance company and the pension fund markets. And frankly, the rates and the deals we'd come up with would not be that dramatic. Probably CMBS would price 25 basis points or a quarter of a percent more or higher than insurance companies, but they were fairly close. They were fairly competitive. Now, we've seen a difference between CMBS and insurance companies of about 150 basis points. In other words, 1.5 points. So that if you want an insurance company loan, you could get rates in the 4, 4.25, 4.5 range. But if you want to go to the CMBS market, it's going to be in the 6% range. And really what that's brought about is kind of the haves and the have-nots. Obviously, to the extent that you could access an insurance company or a pension fund, why would you go to CMBS? And the answer is you wouldn't. So what drives that? One, location. Smaller cities are not as likely to get an insurance company or a pension fund deal. Two, strength of the borrower. And three, relationships. What we found is the relationships with insurance companies are critical. The CMBS market is a lot more transactional. So there are actually, these two classes of borrowers, the haves and the have-nots.
So is there capital available for higher leverage?
Yeah, there is. And that's the good news. I think we've talked about several times the fact that loans today are being made with less leverage. So instead of having an 80% loan or an 85% loan, you're more likely to have a 65% loan. And since most borrowers are cash poor, this is a real problem. How do I do my deal? And the answer is we've had substantial success with higher leverage facilities, and these can come in the form of mezzanine debt, preferred equity, joint venture, and they come from institutions for the most part. They are more complex, they are more expensive, but they also let you access these higher leverage alternative vehicles so that you can do your transaction as opposed to being stuck with just a lower leverage first mortgage, which is the kind that's more commonly available today.
All right, thanks, John.
Delighted.
For more information, give us a call at 804 644 2000.